Hi there, this is Dennis Wells. One of the most common questions that I get from clients is whether buying discount points actually makes sense. So let's break it down plainly. Here's how it works. When you buy a discount point, you're paying upfront cash now to lower your interest rate. 1 point typically costs 1% of your loan amount. So on a $400,000 loan, that's $4,000. In return, you usually get about a quarter percent, sometimes a little more or less depending on market conditions, knocked off of your rate. So the question isn't whether points are good or bad. The question is, how long are you staying in the house? Because buying points is a trade off. You're spending money today to save money on your payments tomorrow, but that payoff happens over time. Let's say you buy 1 point for $4,000 and it saves you $60 a month. That's almost 7 years before you break even. If you plan to sell in 5 years, you're losing money. If you plan to stay 15 years, you win, and you win big. And here's where people get it wrong. They think about points the way they think about a product, like it's inherently valuable. It's not. Points are only valuable if your timeline aligns with the math. So before you commit to buying points, know your timeline and your time frame. Are you staying long term? And is the break even math realistic for your situation? If the answers line up, points can be a smart move. If they don't, you're just paying money for nothing. Reach out to me. Let's have a conversation and run the actual numbers on your specific loan because that's where clarity lives.